Shares of Plug Power are down about 50% so far this year. The company's had some struggles with production, bringing some of its hydrogen facilities online. It looks like they might have made some progress there. There's also signs that their funding situation is getting better with some big Department of Energy loans that it looks like they have secured. Is it time to finally buy shares of Plug Power? I'm Jason Hall. This is Investing Unscripted. We're going to take a closer look at what's going on with Plug Power. And I'm going to give you one number, one reason why investors should probably still be really cautious of Plug Power. Before we get into the details, though, this video is sponsored by The Motley Fool. We're going to talk about Plug Power here, come to a conclusion about whether or not it's a stock to buy. But if you're looking for even more great stock ideas, you should check out our special link. It's fool.com/unscripted. Go to that link and you can get access to The Motley Fool's 10 best stocks to buy right now. If you really want to supercharge your investing, you should go check out our special link. Again, fool.com/unscripted. Let's start right here. Plug Power stock is down just about 47% so far year to date. And I want to point out too that it's also been really volatile. We've seen regular spikes where the stock has dropped a ton and then gone up a ton and then dropped a ton and gone up a ton on a lot of speculation and uncertainty and also some optimism around hydrogen and particularly its potential to leverage green hydrogen. Now, before we get into more of the details on the stock itself, I want to focus back around on the business because at the end of the day, if you want to be a successful investor in stocks, you need to be successful at understanding the businesses that you are owning and their ability to generate profits for the long term. So we'll start here taking a look at their first quarter presentation. This was back in May. It's going to be early August before we get Q2 results. So this is the most recent full business update that we've gotten from the company. And a few important things happened. Number one, two liquid hydrogen plants that they had been dealing with some challenges with started producing hydrogen, Georgia and Tennessee. And part of the company's thesis, what they're telling investors is that these two plants, which are producing green hydrogen, should help reduce their costs substantially for hydrogen. At the end of the day, that's really important. Bringing those costs down because they have contracts with customers to provide hydrogen, and they need to bring the costs down to make a lot of those contracts profitable. Now, funding has been an issue. This is a company that has blown through a massive amount of money over the past couple of years, spending on capital growth, and those capital projects haven't started generating positive cash flow at this point. So a couple of things happened. This is really the big one, is this $750 million in funding that's from the federal government. It's a loan that should give them additional capital that they can use for future funding projects and potentially to offset capital that they've already deployed in prior projects so they can bolster their balance sheet with that cash. So those are the key things that they told us. They've also taken a lot of steps to try to lower their operating costs, to try to cut their cash burn. So they also did announce some price increases, again, across their entire product portfolio and specifically trying to get better pricing on hydrogen. The bottom line is that it has definitely impacted their cash flows and balance sheet because they've had to buy a lot of hydrogen and lost money on the hydrogen that they've had to buy. We're going to show their operating statement from the first quarter in just a second, break down how ugly it has been for the company, just really burning through a lot of cash right now. And that's something that investors should continue to be concerned about. Okay, so we're going to start with the operating statement from Q1. So short version, $120 million in net revenue in the quarter. That was a massive decline year over year from $210 million in the first quarter of 2023. So that's kind of a yellow flag I want to continue to point out, is that this is supposed to be a growing business right now, and revenues really fell. Now, there's maybe some cyclical reasons for that, some timing reasons on some of the projects that they're working on. So I want to give them a little bit of benefit of the doubt there. But again, you want to see the revenue number needs to really, really be growing, and it's not. So that's a concern. Now, at the same time that revenue fell that much, cost of revenue basically stayed the same, $280 million cost of goods. So this is just your gross margin. This is the first dollars of margin that you earn that kind of pays for everything, pays your operating expenses, anything that's left over you can use for capital expenditures. So you can avoid doing things like raising debt or issuing more stock. But again, at the gross level, $159 million, that's negative gross margins. That's brutal, absolutely brutal. We'll give them a little bit of credit here. Operating expenses brought that down from $140 million to $100 million. But again, you're already $159 million in the hole just from cost of selling your product, right? You're selling $279 million worth of product for $120 million. We know the reasons why on there. I don't want to continue to bang the drum too much on that. But again, starting in a really big hole, did make some improvements in lowering those operating expenses. But again, total operating loss, when you factor in the negative gross margins, negative $259 million. It was an improvement on the operating side. But again, just the revenue amount came down so much. That's the issue. Now, cash flows still ugly as well. You get down here to operating cash flow all the way down here. Improvement, burned $277 million a year ago, still burned $168 million in the quarter while continuing to deploy money investing. This is CapEx, spent $121 million on CapEx in the quarter. So continuing to burn through a lot of cash and to draw cash down. So now I'm going to move up here to the balance sheets. How do you pay for all of this stuff? And you look at it and you think, wow, with all that cash burn, current assets. So this is basically cash, restricted cash, and things that you should be able to turn into cash really quickly, like inventory, prepaid expenses that have a cash value, that sort of thing. You're like, wow, the current assets didn't really come down very much. And then you look at current liabilities and you're like, well, that actually came down. So you know what that means? Your working capital actually got better. Well, how did that happen? How did working capital get better when you burn more cash, your revenues fell down, your cost of goods stayed really high, your operating losses were even bigger? And this is the one number that I think I really want to caution investors about. We'll take a look at this other chart right here. So this is Plug Power's stock price. Again, we talked about the fact that it's down roughly half, 46%. This is in real time as I'm recording this on July 25th. Stock price has come down. It's about $2 a share. A little under $2.50 a share, $2.43 a share at this exact moment in time. And what's happening? What's driving the stock price down? So yes, the losses are driving the stock price down. The cash burn is driving the stock price down as well. The optimism, again, is that the company is going to turn the corner with this funding from the Department of Energy, and it's going to be able to bolster its balance sheet, and the growth is eventually going to come. But there's a little more to the story about what's hurting the stock price right now. And that's, we looked at the balance sheet and how do you have your cash level still the same and you've burned all this cash? They're not taking on a bunch of debt right now. They're issuing a bunch of stock. It is a constant issuance of stock. And this year alone, the share count has increased almost 36%. Here's the thing. That's not over yet. That's not over. The company on July 19th announced pricing for another stock offering of another 78.7 million shares of stock plus a 30-day option for another 11.8 million. So you're looking at potentially another, call it 90 million shares of stock to get issued. And they're selling it at $2.54 per share. So again, we go back over here and the company is basically setting a price that they say is, well, this is what the market is going to bear for our stock. And it's clear that much stock has been issued because the company, since we got the May results, it has continued to sell more stock. It's selling more stock because it's not generating enough cash flow to cover its needs. And that to me is a massive, for me, it's a red flag. For other investors that maybe you're more bullish on their potential to turn it around, it should at least be a yellow flag. That, again, I'm not even looking back at the 20 years before this recent period of growth for the company, but just looking at what's happening right now. The company continues to burn through cash, and so far, those assets that they brought online, we haven't seen any evidence that they're generating cash flows, that it doesn't need to continue to sell stock to the market to raise cash. Just in the past week, again, almost some 80 million total shares of the options extended at like $2.50 a share. So there is a floor that's been set, and the company is saying we still need to continue to raise cash. To me, that's a massive red flag, and it should be at least a yellow flag. Why investors should step very cautiously around Plug Power stock, expecting that the story that they're selling for the future of hydrogen is going to generate profits for investors. So far, they haven't done it. And until they can show they can, I think investors should be really cautious about this stock.